Welcome to the Investor Summit Green Room, the behind-the-scenes monthly podcast where we bring you informal one-to-one interviews, panel discussions and presentations with leading industry specialists, fund managers and financial journalists, which we hope lead you to make better investing decisions. Do please take note, the views expressed in the Investor Summit Green Room podcast are for information purposes only, and nothing in this podcast constitutes a financial promotion, investment advice, or indeed personal recommendation. Today we welcome Tom Bailey, Head of Research at HANetf, a specialist provider of exchange-traded funds and exchange-traded commodities. Tom joined HANetf in 2021. Previously, he worked for their interactive investor platform as an ETF specialist, and he's often quoted in the financial press. Before then, Tom worked as a financial journalist, covering investments, markets, and economics. And it's probably worth mentioning that Tom is presenting at the Investor Summit on Friday, the 18th of September, for anyone who would like to catch him in person. Welcome, Tom.
Thanks for having me.
Greetings. How are you today, Tom?
Very well, yeah, getting by with the weather. It's a bit warm. But
yeah, it is a little bit hot. Yes. So how about we start by asking you about HANetf? Where does it fit into the rapidly expanding European market for ETFs? Tell us all.
Sure. So I think the important point to make around HANetf is that we are a white label ETF issuer. So what that means is we partner with third parties, typically asset managers, but not only asset managers, to create ETFs and ETCs for the European market. So what we're trying to provide is those who want to enter the European ETF or ETC market. I provide their investment strategy via that ETF or ETC wrapper with a sort of turnkey solution. So we will manufacture, provide the regulatory requirements, and also the distribution of the ETF in question. So kind of the reason why this happens is often you get asset managers now who want to enter the ETF market, but rather than setting up their own ETF business or ETF division, they can come to white label providers like us to do so. So we're Europe's largest and leading white label ETF provider, and uniquely the only one to be doing distribution as well. And that's quite important in terms of building the HANetf platform. So we started in 2017, coming up to 10 years soon, and our first ETF listed in 2018. Since then, we've amassed around 10 billion in assets under management and have around 71 different ETFs or ETCs on the platform. And so, where HANetf fits within the European ETF market, key way I think to think about it is as providing increased choice for investors by being able to facilitate the entry of new asset managers, new investment strategies, and new IP into that ETF market. So if you look at the ETF market in Europe today, HANetf is responsible for around 20% of all brands in the market.
That's impressive. Now, why, if I'm actually setting up an ETF, why would I actually come to you rather than set it up for myself?
Sure, it's several considerations, but kind of all linked in a way. The cost of doing so, the risk around that, and the execution risk of setting up your own ETF business to do so, and then also the time it might take you to get to market. So in terms of cost, the requirement to hire all the right people who understand what they're doing in terms of setting up and keeping an ETF business and the regulatory requirements around that, and then at the same time the sales team and distribution team you might need to do so to actually sell the ETF in the first place. And then also the execution risk around actually being able to pull that off, and then the time it will take for you to build that. So, if you are an asset manager and you're looking to enter the ETF market, you are presented with broadly three choices. I would say you can start your own ETF business with all the cost and potential risks that entails, or you can obviously acquire an existing ETF company out there, but there's only so many out there that you can actually go and buy, and obviously there's also execution risk there. Or you can go to the white label platform like HANetf, which will give you that kind of turnkey solution, allow you maybe to launch one ETF first. So obviously your costs, you don't have to kind of worry about scaling the size of the ETF so rapidly to cover the cost of setting up an ETF business. The cost will be lower. So you can do one or two ETFs to start and see how they go and learn as you go in terms of what we're able to do with a white label provider.
And are you one of the larger providers of?
We are the largest white label provider in Europe.
Okay.
So there's larger ones obviously in the US, and the US is kind of the leading a place for ETFs, and with that, white label ETF companies. Nearly every ETF you see now coming out of the US, which isn't, say, your kind of iShares or your Vanguard, they're nearly always they're through a white label provider now.
Okay, very interesting. And what are the fundamental differences between ETFs, exchange-traded funds, and exchange-traded commodities? How do they differ?
Sure. So, from a investor's perspective, not very much. In terms of with an ETF and an ETC, you go onto your brokerage account, you see the price, you click buy, or if you already own it, click sell it on an exchange through your brokerage. It's essentially functions the same way, but they are different legal regulatory entities. So an ETF is a fund, whereas an ETC is technically not a fund. It's actually technically a debt instrument. Mm-hmm. But essentially both function in the same way. The reason being within Europe, say gold ETCs are the most kind of famous and the largest ETCs by AUM. You can't put just physical gold in an investment fund in Europe. So the ETC is an alternative structure to allow you to do so. I think the letters obviously matter from that legal regulatory perspective. They're structured differently, but the actual experience of an investor is essentially no different in terms of an ETF and ETC, except for what that underlying exposure is. If you own a gold, if you think you own a gold ETF in Europe, you likely don't. You actually own a gold ETC. So it's kind of a technical distinction, but investors, I think, as long as they understand that, and understanding if they're looking for, say, single commodity exposure or some other asset classes which aren't allowed in an ETF, that ETC is just the alternative option to do it through.
So I've held gold in a gold ETC,
yeah,
and I was advised on the way in to make sure that it was a physical gold. So why was that advice given to me?
So there's with a lot of commodities, obviously there's a futures market for gold. So you could, some of the ETCs might offer those futures markets. You get within that kind of extra cost, counterparty risk, the rolling costs of kind of selling and rebuying the futures on the curve as the futures expire, because the futures do expire. Whereas physical is different in that it's physical gold, which will be allocated to the ETC in a vault. And therefore it's physically backed. You have a claim on that gold itself rather than the futures contract. The market has increasingly moved towards physical gold for ETCs. It's not possible, say, for some other commodities, given the bulkiness of them. But gold obviously is a precious metal. It's about $4,000 for an ounce of gold today. So in terms of storing and infrastructure for the storage is
4,400, my good man.
Sorry. I didn't know when it was going to go out, so it could change very rapidly. Who knows?
Believe me, at the moment it is. Excellent. Okay, now to talk about something completely different, I'm told that 1 in 5 UK investors currently hold an exchange-traded fund in their portfolio, up from 1 in 5 now, and it was 1 in 20 5 years ago. Now that's quite a jump from a tiny percentage, really, to 20%. So why such a rapid rate of increase?
Yeah, I think there's several reasons behind that. Over that same time period, the number of ETFs available in Europe jumped from around 2,000 to around 4,000. So there's essentially twice as many products, which obviously means that, there's more choice out there for investors. There might have not been products in the past that investors were interested in, which now do exist over that same time period. But then at the same time, I think, it is the strength of the ETF wrapper itself, I think is a large part of this. Obviously at HANetf, we're evangelists for ETFs, but I think it's correct, is that, if you look at the ETF structure, say, versus your alternatives out there, the ETF has significant benefits. So, for example, comparing them to mutual funds or OICs, open-end investment companies, the key difference there is that an ETF trades on a stock exchange throughout the day, which means if you go in the afternoon, say in the early afternoon rather, to buy that ETF, you see what the price is, you click buy, you get it at that price, you click buy at. Now, if you go and buy a mutual fund in the middle of the day, you might click buy, but you're not actually going to get the price you're paying until the end of the day. Now, that's quite an archaic way to buy something. I can't think of many other instances where you would agree to buy something before you know the price you're going to get it for. So it's just, in our digital age, the idea of not being able to get a price when you actually buy it just doesn't seem to make sense, I think, for a lot of investors. And then, also that same time frame, I think about it from, say, 2021, I think you cited, to 2025.
Yeah.
Another key part, I think, is, the direction where the market is going. So a lot of younger investors get into investing around that time period, around lockdown, that second lockdown in 2021. And I think just the natural route for investors, younger investors, is to simply go for ETFs in the first instance. Not to say they'll never buy a mutual fund or investment trust or anything like that, but I think the ETF has become the kind of the natural fund structure for millennials to Gen Z.
So the reality, I completely agree with you in terms of trading, but do people really genuinely find ETFs as easy to understand? Because I find them as difficult as any other financial product. There's a degree of getting your head around an ETF as there is anything else. What do you think?
Yeah, I think there's kind of several parts to that. On a surface level, ETFs are relatively simple to understand. If it tracks the S&P 500 or the FTSE 100, then you can buy shares in that ETF on the day. That's really simple to understand. Thematic ETFs might get a little bit more complicated, but they're still relatively easy to understand in the investment strategy sense of, you can read the methodology or the summary of the methodology on the issuer's website, and it'll tell you, this is a thematic ETF geared around defense stocks. This is a defense ETF. It requires stocks to have 50% revenue towards defense to be included. There's more of a layer of complexity, but I think it's easy enough to understand. Or if it's an active ETF, it's the same process in terms of understanding the investment manager's philosophy and approach to investing. The smarter bit on ETFs is behind the scenes, the ecosystem that keeps ETFs working. So you mentioned kind of the investment trust angle there, and I think it's always interesting to compare ETFs to investment trusts, because both are fund structures, essentially, or collective investment vehicles, which you can buy and sell on a stock exchange. Now, the key thing about ETFs is they trade on an exchange, but you won't see them have these large discounts and premiums emerge in the way that investment trusts do. And this is why I think, even though it's complicated, it creates simplicity for the investor. So if you're looking at buying an investment trust, you have to then, you want to go and look at, okay, what discounts it's trading at? It's trading at a 15% discount. Is that a historic norm over the last 12 months? Hargreaves Lansdown will tell you what the historic norm was over 12 months, but why is it the case? I'm buying at a discount, or if it's trading at a premium, you're buying essentially the assets at a premium when you buy that investment trust, and so why is that the case? Will it persist? Is it going to normalize back down? And so that's a lot more complicated for an investor to deal with. Now, ETFs have premium discounts, but there's a whole ecosystem in place to essentially remove those discounts or the premiums as soon as they arise. So, and that's one of the kind of key differences with an investment trust. So what you have in the ETF world is what's called an authorized participant. So these are essentially market makers, which are always monitoring the premiums and discounts of ETFs. Say the shares of an ETF, it's £100 for one share in an ETF, and the value of the underlying shares of that ETF, just say FTSE 100 for easy's sake, coheres exactly to that, and there's no premium or discount. But then you see buying in the ETF, and so it goes to £101 per share, but the underlying has stayed the same. That's obviously what that premium would be. Now, obviously, in an investment trust, nothing really happens. Obviously, it persists over time. Who knows, the board might decide to issue new shares, but there's a big time lag there, and that's what you're worried about if you're buying an investment trust, is, say, buying at that premium sometimes. With ETF, as soon as that premium arises, the authorized participants will step in. So these are market makers who will then go and buy the underlying stocks that the ETF holds. So they know what the ETF holds. It's published every day on every issuer's website, all the underlyings. And then they will trade those underlying stocks for new shares with the ETF issuer. And so what that does is it allows essentially that premium to get arbitraged away, and it works in reverse for discounts as well. So that's relatively complex, but it's not the concern of the investor using the ETFs actually to really have to worry about that, because they are not going to see the premium or discount. They're not going to buy an ETF at a large premium or sell it when it's at a steep discount.
That's a good, if complex, answer, but it was exactly the answer that I received. I was talking about ETFs and the fact that I was going to be doing this interview today with my Signet group, and that was exactly the answer that one of our participants, Mark, gave the group. So there you go.
Yeah, I mean,
you're ranking pari passu with our Signet group, Mark.
It's quite a complicated concept, but at the same time, it's a very elegant kind of way for a fund to maintain that ability for the price and the underlying value of what it holds to stay the same while still being traded on exchange.
Let's go back to the historical roots of ETFs. Where did they come from? And if you could track their journey towards success, the success they undoubtedly are today.
Yeah, so ETFs start in the first ETFs in the early 90s. And the story of how they came about is kind of funny, I think. So obviously you have in 1987 the big market crash, and then you have from that the SEC has its kind of post-mortem of it. And in there's a few lines to the effect of, had market participants had an instrument which tracked the entire market that they were able to buy throughout the day, that could have stabilized markets and reduced some of that drawdown. Now from that, several people kind of got a brainwave, it seems like. The most famous is Nate Most. And so him and various other people kind of went away and thought, well, how can you create a fund which is able to be bought and sold throughout the day, obviously without that problem of a premium discount emerging. And what they came up with was essentially the ETF structure. And then from that, you got several of the first ETFs launching in the early 1990s. I believe the first one, which doesn't exist anymore, was on the Toronto Stock Exchange. But the first one in the US, which is still in existence, is SPY, the US S&P 500 tracker, which is still around today. It's often the largest ETF in the world, sometimes overtaken by other ones. Briefly, depends what investor preferences are. But that's the kind of broad history of
what
the
does
ETF.
Large look like in ETF terms?
Well, trillions.
Trillions.
Yeah.
What would an average size of an ETF be?
In terms of the average, so we say trillions is singular. Actually, a trillion is actually the largest ETF in the world. 1 trillion. It really varies. Typically, we'll launch an ETF with our $1 million in seed. So and then obviously the goal is to grow that to get 100 million and 200 million to $1 billion.
What's a viable size, would you say?
It really varies on the cost structure of the firm, as well as the expense ratio that's being charged, because obviously every fund has a fee it charges the investor. But generally, 50 mil and up is relatively safe territory for the ETF being viable. But obviously you want to continue to keep it growing. There's no point of letting it hang around at 50.
And I hadn't quite realized that the US and Europe have different structures, different financial structures. So could you explain how that's come about?
Yeah, it's I think what's important here is just to distinguish, talk about US ETFs versus European ETFs, not talking about the underlying exposure. I'm talking about where the funds are domiciled and listed.
Yep.
So obviously, European investors can buy, and they do buy in large quantities, ETFs which hold American stocks. What they can't typically buy are US listed and therefore US regulated ETFs. And essentially the issue is, an issue or not, it's not my place to say, but the reasoning in is that the European Union, the UCITS fund structure requires certain disclosures, and US funds aren't set up to provide those disclosures. And so what you have is essentially two markets created by regulation, the European market and the US market. But it also, at the same time, you wouldn't necessarily have everyone in Europe buying US ETFs, even if that was the case, because a lot of investors in Europe don't want to buy an ETF in another currency, because then you have the currency aspect on, say, whether you're holding it through, like if you're holding it on a platform, you might have an FX charge on that platform. But obviously what that means is in Europe, you'll get ETFs that are listed. They'll be listed on a German exchange in euros, on the Italian exchange in euros, on London Stock Exchange in sterling. And also you'll get still a listing on the London Stock Exchange in dollars for those who that's more suitable for. So you have these two kind of markets. Call it the 40 Act, which is the kind of regulatory regime structure for US listed ETFs, which kind of then typically European investors can't buy. And then you have UCITS ETFs, which is the European structure. What's interesting is what happens outside those two markets sometimes. And increasingly what we're seeing is, say, investors in Latin America and some parts of Asia increasingly want to buy the UCITS, i.e. the European fund structures.
Why do they want to buy European?
It's often just more tax efficient for them to have a UCITS version than a US one.
Who knew? Right. Okay, an opportunity for you to pitch to us. Which sectors and types of ETF do HANetf specialize in? And, what are the fast-growing segments that you're involved in?
Sure. I mean, so first, I'd say, we specialize in ETFs, ETCs in general. If anyone, any asset manager out there has come with us with an idea.
It's a wrapper.
And they come.
And you specialize in those two wrappers.
Yeah, and how to then get that, how to create a product to reflect a strategy in that wrapper, and then at the same time working out, is it something that would have a decent market in Europe? Do European investors want to buy it? That said, obviously, we've been doing this since 2017, and actually our senior leadership team have been in ETFs in Europe from the start. So there is obviously some specialism in certain segments. When it comes to gold ETCs, our co-founder and co-CEO, Nick Benkowski, he was instrumental in the invention of gold ETCs back in the early 2000s. Our chief operating officer, Manoj Mistry, was head of the team which created the first ETFs within Europe as well. So there is that kind of specialism there, and particularly around gold, as mentioned with Nick. So we do our own gold products now on the platform, not our own. We actually partner with other people, such as the Raw Mint, to do this. But I'd say gold is one of those key areas of specialism. And then at the same time, defense. We've got Europe's largest range of defense ETFs out there, and we have around 4 billion in AUM spread across those defense ETFs. We were early to the market with our defense ETFs, which has obviously allowed us to see relatively strong success with those.
Weightings must be pretty important in the construction of an index and an ETF.
Yeah, it was kind of, you can find, it's often a popular way to do a thematic ETF is to equally weight something as well, so that every name is equally weighted regardless of, so the size. So, some, theoretical tech ETF, you'd have, say, the same weighting of Apple with another name in there, because you're trying to say, actually, we don't want to take the market cap weighting as key. Or you can do what I just spoke about in terms of like capping those weightings and saying actually the largest names can't exceed 5% or 10%, whatever makes sense. And obviously what we want to do is kind of take it on a case-by-case basis to see what makes sense as an exposure.
Where did you look to find out as to how that ETF has been sliced and diced?
So if you look at the index methodology, it will tell you what the weighting caps are. So it depends on the complexity. If it's equal weighted, it'd be very clear what's equal weighting. Then when it comes to, say, what we call modified market cap weighting, and that's that kind of capping we talk about. So you allow it to be market cap weighted, but then you're capping them at certain levels anyway. For that, so on our website, you'll find a relatively easy explanation on any of the products for how we've done that. Mm-hmm. You can always look at the methodology of the index as well, which would explain if there's like a scoring tier system and how that works.
Okay, AI. Got to ask you about AI. I'm assuming it's had a positive impact on your business. Has it allowed you to create ETFs more quickly and helped you actually in the physical pulling together of them?
Well, I guess it's a counterfactual, right? Because it's been a record year for the number of ETFs. We're on track to create a record number of ETFs for us, for a company. Oh. Now, obviously, we, like all businesses, we've integrated AI into processes where we think it's smart, appropriate, and safe to do so, to kind of automate processes. Would we be able to do that without AI? I suspect we still would have done it, mm-hmm. but maybe it would have been more of a challenge for members of our team. So it's kind of hard to say. Obviously, we're as a company, we're very open to using AI where we think is appropriate and safe to do so. But at the same time, each year we're growing faster and faster. So it's kind of hard to tell,
people don't write code anymore. They get Claude to program it.
Yeah, so. And it's like you see lots of kind of the kind of daily processes as being automated to kind of free up the guys to do other stuff. Well, obviously, this is Jevons paradox, right? It's just because something is cheaper in a sense of less human resource to do doesn't mean you do less of it, or you do less. You just you do more anyway, which is
it allows the team to do different things.
Yeah. And then with AI. One of the areas I found interesting, not so much us, but it kind of affected how we had to think about, say, like digital marketing, is because it's changed the journey of investors to find out about ETF issuers or ETFs. So obviously people used to Google, they would read, say, guides online, which would pop up. now instead they're going through the ChatGPT or Claude and asking, I want exposure to X theme or Y theme. Which are the best ETFs for this? That's what they're writing in now. And so it's about obviously having your, whereas used to be a lot of focus on that SEO, search engine optimization.
And your ranking, your Google ranking.
Yeah, now obviously that's still important because still a large chunk of the population use Google to find what they want or they're looking for, but a large and growing chunk are using ChatGPT. So ensuring that you have what's called AEO, which is AI engine optimization, from my understanding, which obviously is trying to make sure that you are appearing when someone says which ETF issuer should I look at in Europe, that it says HANetf.
Presumably not all ETFs and ECTs are equally as safe and well run. What practical advice could you give investors who are getting their heads around ETFs? Some practical advice.
Yeah, I mean, so when it comes to, I think the UCITS structure is investors can rely on, and it's a very well regulated market. Often what we say to investors, if you're buying an ETF or an ETC, you've got 3 layers of regulation there. So the product itself, the ETF or ETC, is regulated. Then it's listed and sold on a regulated entity as a stock exchange, whether it's Xetra, Deutsche Börse in Germany, or the London Stock Exchange here. And then third, you're buying it. You're not buying directly on the market. Typically, if you're a private investor, you're buying on an investment platform, which again is a regulated entity. So you've got those 3 layers there in the first place. So I think but that doesn't protect you from price risk. What you bought doesn't perform the way you hope it does, and the only way to protect against that is to properly understand what you're buying, what it's looking to achieve, and how it does so, and therefore why it may not achieve those results. So I'd say always make sure you're practical advice. Always make sure you're going onto the issuer's website, the company behind the ETF. You're reading its objectives, you're understanding those objectives, you're understanding how it's structured, the exposure, whether it's for an active manager, what his or her philosophy is, whether it's for an index, a broad sense of how that index actually works in the first place. And so you know what you're buying, essentially. Now, obviously, within that, there's still risk. Obviously, you can understand the product and the market can still move against you, but at least then you've not bought something under the false illusion of what it could or can achieve.
So we're coming to the end, Tom. Why did you join HANetf? What's the attraction of the ETF wrapper for you?
Yeah, I mean, when I was a journalist, I found the whole active versus passive debate very interesting. So I was writing a lot about ETFs in that kind of active versus passive context. Then I joined Interactive Investor, which is where then I met the CEO, founder of HANetf, Hector McNeil. And the reason why I met him was because I was writing increasingly about the various different ETFs on the HANetf platform. It's because they were launching a lot. It was interesting. So I met Hector and then eventually ended up working for him. And so, I'd say one of the reasons I joined, but also one of the reasons why I'm still here, is essentially, to me, it's really interesting because, we're launching all these different products. We're going through these different themes. So, when, say in 2022, did a lot on, we had some uranium products launch. So learning all about the uranium market, nuclear energy. Then obviously we had our defense products, learning all about the defense sector, defense industry. So what keeps me kind of wanting to stay at HANetf is each month is a new topic that I need to kind of take a deep dive in, and so it always keeps you interested and engaged. Not to say that the old ones become boring. I still find uranium very fascinating, but there's always new topics to learn and new segments or industries to kind of get your head around to actually be able to understand the products.
Okay, so as a final question, and I really do mean as a final question, because we are sadly out of time. What would your trading advice be in terms of people using ETFs? What are the things to watch out for? What are the positives of ETFs? What sort of advice, given that you're a seasoned ETF man, what advice would you give?
My advice, I think, would simply be make sure you understand what you're buying in the first place, and then what you're hoping to achieve with that. Are you buying this as a kind of short term? You think there's a price dislocation, or are you buying this as a long term holding? And kind of as with all kind of investments, what your thesis was when you bought it, assess against what it is over different periods in time. Do you still believe it, or are you just holding on because you bought it for reasons which you no longer agree with? I think it kind of is broadly the case across all different investment funds. But understanding what you're buying, why you bought it, and then why you still hold it in the first place.
Good man. Thank you very much indeed for joining us. Tom Bailey, Head of Research at HANetf and an expert in exchange-traded funds. Thank you hugely for sharing your knowledge with us today. For those watching, thanks very much indeed for your time. And Tom and I look forward to seeing you at the brewery on September the 18th. If you haven't yet bought a ticket for the Investor Summit, get yourself onto the Summit website at www.investorsummit.co.uk and you can buy one there. And please do look out for our next podcast with Charles Hall, Head of Research at one of the UK's largest brokers, Peel Hunt. And here I am again on the Green Room sofa with Sam Bell, CEO at Copia and the Investor Summit co-founder. Sam's an experienced private investor, and I'm learning what portfolio diversification really means. We're here to discuss the big investor moments of the week, none of which is investment advice, of course. Welcome, Sam. How are you this week?
Yeah, very good, very good. And yet another interesting interview, one that you and I have been pushing to have for a few weeks now, ETFs.
Well, ETFs are just exactly where you want to be. It's the sweet spot of the market at the moment, isn't it?
Seems to be. Lots of people, interested to learn how they work if they're not already invested in them.
Yes. So an interesting stat that I pulled out of the previous interview, the Tom Bailey interview, 1 in 5 UK investors have an exchange-traded fund in their portfolio, up from just 1 in 20 5 years ago. That's some rate of growth.
Yeah, it really is. And you could probably say the platforms have had something to do with that. They're somewhat billed as the default investment option. So, if you're not a single stock picker, which I tend to be, and you type in funds to invest in, you're gonna see a lot of ETFs over investment trusts.
Do you think it's a head-to-head competition between ETF, SOICs and investment trusts?
Yeah, very much so, and one that ETFs seem to be eating away at the market share of the other two. It'd be lovely, as it would be for the whole market, to see many more people getting into investing, whether it's single stocks, open-ended funds, or exchange-traded investment trusts. Whatever it is, more people need to be investing, which is why we run this Investor Summit, to try and educate people. But it seems that ETFs are chipping away at some of that investment trust money.
Is it as simple as they're easy to trade during the day as opposed to investment trusts, which can be a little bit clunky?
Yeah, I mean, obviously it's going to depend on the size of the investment trust and the liquidity of it. But, an exchange-traded fund, you can be in and out quite simply because it's replicating the underlying in most cases. Investment trusts, you've got to get your head around discounts, premiums, what the board's up to, all the usual reporting standards. So personally, I think it's a good idea to be knowledgeable in all these areas, but you can understand why some people head straight for the ETFs.
Quite. I think they make it easier for a less experienced investor.
Yeah, definitely. And of course, some of these ETFs should be simple to understand. Some of them follow single stocks, right? They're just leveraged 2 or 3 times, or they follow a single commodity. I think we talked months ago about something I was holding, which was essentially held uranium. But you can do the same thing without the volatility of it being a standard listed entity, and it will just follow the price of uranium if it's an ETF. So somewhat simpler for people to understand, I think.
Simpler. And it's August. I think we have to discuss August. I never know whether people are actually ghosting me because it's August and they're on a holiday, or whether they're actually just on the beach in Saint-Tropez and therefore not answering emails.
We discussed this a bit, didn't we? Where it's so rare, certainly for me. I can't remember the last time I put an out of office on, because I'll sit by the pool or on the beach and answer a couple of emails. Not suggesting for a second I sit there and work all day, but I'd rather just spend 5 minutes replying to someone between beers. That's
my preference as well. I just rather keep on top of things.
Yeah, maybe not the healthiest for everyone. Depends on the way you would like to work, and if you're capable of turning the phone over and not looking at it. So yeah, it is hard to know if.
Anyway, I'm sure I've been ghosted.
Don't want to reply.
The reason I've not done all these things, Sam, is because I've been ghosted, and none of the people I'm speaking to are actually ever getting back to me.
We've made some great progress in August. We've got
We've done
Investor
well.
Summit, full lineup, hundreds of people registered already.
It is ridiculously good. Tell us about the Investor Summit then, Sam.
Well, it's taken a bit of a life of its own this year. Mm-hmm. The caliber of people coming, not to say that last year, we didn't have great speakers.
I thought last year was unbeatable, and I thought there was no
way
way
we got all the same people back, and even more. We've passed the 70 speaker mark, which has been somewhat interesting to keep on top of and handle for us and for the rest of the team. But lots of panels, which are always great. Thinking of stuff like we mentioned the platforms and how they list ETFs. Well, we've got the 3 big platforms plus Fidelity on a panel. We've got 3,
which is pretty unheard of, to be fair.
Yeah.
The four major
all
Fidelity
happy to sit on
panels.
stage and talk about what they're doing, hopefully in a friendly manner. 3 largest registrars, got the stock exchange in the room on a couple of panels.
So why should I be interested in the 3 largest registrars?
If you're investing only in ETFs, perhaps it wouldn't be of interest. But if you're this kind of person that picks individual stocks,
single stocks, which a lot of our audience are, I'm sure.
Yeah, they absolutely are. The idea is people come and they learn about these other things. So we want people to learn about investment trusts and ETFs as well. But if you are a single stock picker, these are the people making sure you get your dividend, making sure your name's perhaps not directly on the registrar. We do have a strong nominee system here. But they are, the nuts and bolts of how the market works. And I think if you're a serious investor, it's good to understand this stuff.
It's good to understand the things that you don't understand. And that is what we will be doing for you on the 18th of September.
What it is. It's all education. What can we teach people?
Even for the folks who don't think they need education, we'll be taking them to the parts of the market that they don't actually know about.
Yeah, and I think this is a phrase I've used a couple of times as we've been talking about this. Somewhat selfishly, I look for talks where I think I'll find that really interesting. So hopefully other investors will as well.
I'm sure that's the case.
Yeah.
So, yes, my portfolio has actually had it's going well, but the market is so volatile at the moment. Every day it's up and down, and I'm never quite sure. The underlying theme for me has been gold has been up about 20% or so, and I'm in Greatland Resources, so that's very much benefited.
Yeah, and that seems to be bucking the trend of the wider market. Gold was taking a real hit, somewhat unexpectedly for a lot of people, as the Strait of Hormuz and Iran and all of that was going on. That seems to have ramped back up at the same time as gold has decided to turn back up. So it's very complicated to follow as an individual investor. Exactly what is driving this stuff.
It's very difficult. That's what I'm looking at the market, and I'm thinking, I'm not really understanding what's driving the market up and down on a daily basis. It's ultimately my portfolio is at a high. It's at a high on different days for different reasons, which is insane. But it's genuinely, I'm a big follower of Marks and Spencer. I'm overweight Marks and Spencer. I was up 12% on Marks and Spencer, but I'm down to about 4% on Marks and Spencer.
Yeah.
Why is Marks and Spencer volatile?
As you said, word of the week, word of the month, perhaps, going to be volatility.
Volatility. Yeah. I genuinely, it's driving me nuts. Okay, talking points of the week. It's been quite quiet. Andy Burnham's been on holiday, but you astonished me before we came on air. Okay. You said you thought Andy Burnham had been making some quite sensible comments or making some...
Yeah, there's a lot of tickling around the edges with £2 bus fares and cost of living tour, things like that. And you know me, I'm a massive cynic.
That's probably wise, though, to be fair,
there's talk of, planning reforms and reforming... Okay, they're probably not going to go ahead with it, but there was talk of reforming council tax, which has needed to be looked at for decades.
It's needed to be looked at for decades.
So there's
political minefield for whichever political
some
party
far
changes.
more sensible ideas than I was ever expecting coming out of this government. But it's whether they one, have the political will to go through with it, and the other is if the markets allow them to. The guy rode into Downing Street with rates going up. I mean, it was only five basis points. But I think it's, we're up another 5 to 6 basis points as we speak from when he was there within a matter of weeks.
So who runs the economy? Is it Andy Burnham
all of the
Healy?
time? Yeah,
Or is it the bond market?
All the time. It's limiting their options. If the markets disagree with it,
they have limited options. They don't have much wriggle room, and they don't have much of a budget to spend.
Yeah, and then you've got opposition parties looking at slashing or suggesting that they will slash things like benefit bills to pay for it all. But again, when it comes to them getting into power, if they'll have the political clout to do it. So
the devil's in the detail. It's how you actually do these things without screwing the system. The system is all these systems have broadly got to work. Social care has got to work. The health system's got to work. But how do you do it without making it all fall over?
Which is why I'm very much not in politics and don't wish to be.
Very good. Well, there we go. We'll draw a line under August, shall we, Sam?
Yeah.
But in a week's time, we're coming back with a gentleman almost becoming a friend of the Investor Summit.
Charles Hall.
Charles Hall, thank you.
Yeah.
Charles Hall, the head of research at Peel Hunt.
Who has some brilliant opinions on where the markets are going, where they've come from. A lot of knowledge there. So looking forward to that one.
Are at the epicenter of the FTSE 250s and beyond. So really interesting to hear what the man from Peel Hunt has to that one. He's single-handedly he's a bellwether for the UK economy, I think.
Yeah, that's going to be a good interview. So
next week. Sam, thank you so much for joining me on the sofa. Sadly, once again,
always,
we're out of time. It was great to catch up with you. Thanks as ever to everyone for watching, and do look out for our next pod with the inimitable Charles Hall, head of research at one of the UK's largest brokers, Peel Hunt. Thank you. Do please take note, the views expressed in the Investor Summit Green Room podcast are for information purposes only, and nothing in this podcast constitutes a financial promotion, investment advice, or indeed personal recommendation. This Investor Summit Green Room podcast is produced by Copia, creators of investor events, video, and websites. If you've enjoyed our monthly podcast, please do subscribe on YouTube or follow us on your own podcast platform. And of course, we'd love to hear from you.